Welcome to the Gold Newsletter Podcast, your bank of knowledge of investment, economics, and geopolitics. Go to goldnewsletter.com for our publications and archives.
This is the Gold Newsletter Podcast. Fergus Hodgson, your host, joined by Brian London, my co-host in New Orleans, and we have Lawrence Lepard. He is a first-time guest, but he is a long-time sound money advocate. He's an investment manager with Equity Management Associates. He studied economics at Colgate and has an MBA from Harvard. And we're so glad to have him. Welcome.
Welcome. Thank you very much for having me. It's an honor to be with you guys.
Right. And just before we began the show, I enjoyed a lot of the tidbits you were dropping. And one was about the Printathon has no end, right? So you said we've entered this era of money printing, perhaps like never before in U.S. history. And why is this just stuck in motion? And Brian has mentioned this before, but why do you think there can be no pullback?
That's aimed at me, not Brian, right?
Yes, that's you. Yeah.
Yeah, absolutely. So the credit bubble that just burst, and COVID was the trigger, has created enormous financial distress, and obviously the Fed and Treasury came in with enormous response. Over $6 trillion, and a big piece of that was in the form of debt monetization. At least $3 trillion of that has gone onto the Fed's balance sheet. And another couple trillion, I was just checking this morning from the Fred site, has gone into the bank's balance sheets because the bank reserve requirements were taken off in March. Another way of getting people to buy the Treasury debt. And what I think you're seeing is that in a system that's built on debt and debt creation to fund GDP growth, once GDP stops growing, it almost has a Ponzi-like nature to it. And the printing has to ramp up, or else asset values and asset prices collapse. And that's what we saw in the beginning of March and mid-March. And of course, the response was, no, we can't have that. We're gonna figure out a way, full faith and credit. There are no limits. I mean, it was, in a sense, it was Powell aping Mario Draghi and saying, we will do whatever it takes. And that's what created the stunning rally in the stock market, even driven the NASDAQ to new highs, which is amazing to me. And really what they've come to show us is that they have no intention of letting the stock market or the economic price structure self-correct and letting asset values return to what they should be, in a system without rapidly growing money supply. And so you've seen, M2 has grown at 23% annualized rate. It's stunning. There's a chart in my report, which we'll talk about later, that shows that. And you've seen, enormous credit creation from the Federal Reserve, and then capital spending actually out of the Treasury. And then, of course, a way of getting around the Federal Reserve Act, where they've created these special purpose vehicles where they can lend a small amount of money to the Treasury, and the Treasury can lever it up. So it's a printathon for the ages, and I think it's probably the last printathon before we have enormous currency valuation debasement, and perhaps even collapse. I mean, certainly people who are smarter than I say that that's a likely outcome, and I certainly think it's a possible outcome. It's impossible to know exactly the course we're going to take here, but I think to be on the side of debasement of the currency, it's never really been an easier call. And so I think one of the things you're going to ask, one of the things I know we talked about in the pre-show was, why is this different than 2008? Because the same thing happened in 2008. And in fact, that's when I got into the business. I was doing something else. I was a venture capitalist for most of my career, investing in growing technology companies. And when I'd retired or semi-retired, I was investing my own money. And 2008 came along, and the housing bubble collapsed, and they did an amazing thing in my mind. They took interest rates to zero and printed an enormous amount of money, or created an enormous amount of credit to fill the bank balance sheets back up. And I thought, that's it. The currency's doomed. We got to buy silver and gold mining stocks. And I got into this area. And so for 12 years, I've suffered as an investor in this area. The first couple of years were great. And then from 12 or late 11 to 2016 was one of the more deeply religious experiences as an investor I've ever experienced, because they were able to, get the cycle going again and make gold go down. And there's a lot of reasons behind that. And but they only created a bigger bubble. They solved the debt problem with more debt, or alcoholism with more drinks. And so when this one finally burst, I think this is the last one because it's at the sovereign debt level. And the only way they can try and put things back together again is to print, or else the economy it dies. And so that's, to me, this is the end game, and we finally arrived.
Lawrence, it's Brian here. It's a great pleasure to speak with you. We've only met on Twitter, and you're obviously both part of that kind of gold bug community on Twitter, which I really urge any listener, even if they're not on Twitter, to get an account and start following Lawrence and the people Lawrence and I follow, because it's a great little community on there. I think growing community, and lots of superb information and timely information and reporting on the gold market. Lots of minds looking at the same thing, in other words, brilliant minds, smart people. And it's a great way to get caught up very quickly. But before I get too far astray, on your point, the differences between post-2008 and post-COVID, I too was amazed that we didn't get an inflationary impact from the post-2008 recovery, reinflation, because it was so enormous and unprecedented. And of course, all those records have been broken and new programs have been dreamed up for this post-COVID event. What it seems to me, the two big differences this time around that seem to guarantee that we're going to have some level of price inflation, real ground level inflation, is one, a lot of the stimulus this time is aimed toward Main Street instead of Wall Street. And two, we've had both demand and supplies disrupted through this crisis, but we know that demand comes back much more quickly than supplies, particularly in commodities. And so you're going to have diminished supplies if and when demand increases to meet increased demand. And of course, we're coming off of such low levels that there's going to be, I think, some shocking numbers in the retail price inflation statistics.
Yeah, I completely agree, Brian. There are several things that are different, and you point out that they've gone direct this time, obviously, with the $1,200, $2,500 checks to families. They've also gone direct in terms of the loans made to businesses, and I discovered this weekend even churches. They've spent money like truly drunken sailors. There were some other reasons why. You say after 2008 there was no inflation. Most people don't remember this, but there actually was a lot of inflation between 2008 and 2011. And it's worth discussing what they did to put that back in the can. If you recall, in 2011, when silver was going towards $50 and gasoline was printing a 4 number, there was price inflation showing up everywhere, and Bernanke knew he was in trouble. And they did a couple of things. One, they launched an attack on the precious metals through the futures market, which is pretty well proven and documented. Nobody could have traded the volume those guys traded to sell it short. And then two, they put in something that they called Operation Twist. And if you look at if you look at what is the longest term driver, what's the biggest indicator of inflation expectations, it's the yield on the 30-year Treasury bond. And at the time, the yield on the Treasury 30 bond was in the 5% range, or high 4s, I think. And they went out and they did Twist, which was really devious and ingenious on their part, where they sold short bonds and used the proceeds to buy long bonds. And so they took the interest rate from high to mid 4s all the way down to the 2 range. And so how could you possibly have long-term inflation expectations when you've got long bonds trading in the 2s? And it completely hammered, the gold sector and the commodity sector in general, and it ignited the stock sector, and thus the next credit bubble was born. And so even though we thought that the housing bubble burst was the end of the road, they actually had one layer higher that they could play at. I mean, the one pre the housing burst, as you know, was the burst of the dot-com bubble. And so yet they had one more bubble up their sleeve, which was what I call the sovereign debt bubble, or as Jesse Felder so rightly called, the everything bubble. And so they got another one going. And that's what led to the problem, that we're now seeing unfold. But yeah, you make a good point about, supply is going to come back more slowly. Let me make one other point that's in my letter and people can discuss. There really, in my opinion, there are two kinds of inflation. There's consumer price inflation, which has been understated, and the Chapwood and shadow government stats numbers show that. But in certain areas really show it, right? Like healthcare and education and so forth. I mean, My son goes to college for $75,000 a year. My healthcare bill goes up 15% a year. I mean, it's outrageous. I pay almost $3,000 a month in healthcare with a $10,000 deductible for a family of 5. It's just outrageous. But apart from that, CPI inflation is another type of inflation, which I've labeled CSIP, which, maybe we'll see how influential I am if this catches on. CSIP is what I call commodity substitution inflation psychology, or currency substitution inflation psychology. And what it really has to do with is it's Gresham's law. And so at any given point in time, people have, they have savings or they have currency, and they decide what they're going to hold it in, what form they're going to hold it in. And, in the past, people have been willing to hold savings in the form of the dollar, and they've been willing to, earn money in the dollar. And they have no fear of the dollar going down in value relative to other currencies, or really relative to anything else. And what I would submit is that the dollar debasement has now become so large and so obvious, and gold and silver have started to perform so well, that what you're going to see here is an enormous substitution of gold and silver as the way to save versus the dollar. I mean, gold and silver, gold for the last 12 years, actually longer than that, since 2000, has been up on average about 11% a year. You'd be hard pressed to find any savings account or interest-bearing security that has paid that kind of a return for the last 20 odd years. So, I think what's going to happen is, to the degree people have savings, of course, many people don't, but I think people are going to come to see that this currency, they can never stop debasing this currency. If you study all great inflations or hyperinflations, the way they happen is when the psychology changes, when people come to the conclusion that, oh, I get it, this can never change. Yeah, we won World War II and we had the reserve currency and we had a stable system, but that's all changing slowly but surely, inexorably. And as a result of that change, it can never stop. The printing has to continue. And not only does it have to continue, it has to get larger. And once they realize that, they'll see a metal going up and they'll say, hey, why am I saving in dollars? I mean, it's pretty easy right now. You can't really get much in your bank account, your savings account anyway for your dollar. I mean, maybe you can go buy a 10-year and get 65 basis points, but that's not much. And they're going to say, you know what? This gold stuff goes up all the time. Screw it. I'm out of here. And bondholders are going to come to the same conclusion. People who hold all these bonds and are forced to hold all these bonds are going to say, yeah, I'm going to get paid back nominally, but it's not going to have the real purchasing power that I put in there. $1,000 isn't going to buy much. And so the inflation here gets driven not by the demand, the demand pull or the cost push that we all learned in macro, in college. The inflation here gets driven by the psychological change of, this government's out of control and has to keep printing from now until forever. And as a result of that, I've got to protect myself. I've got to own a currency which will not be debased. And the best one that everyone knows is such a currency is gold. And the second best one is silver. And so, when we take out the, high of 1921 an ounce in gold, which is coming probably fairly soon, we'll be at all-time highs, and just, there'll be greater recognition. And guys like Brian and myself, who've been off in the wilderness talking about this stuff for 10 years and everyone thinks we're nuts, will suddenly start to look a lot smarter, even though we really haven't changed. So I think that's what's coming.
The Gold Newsletter podcast is proudly sponsored by the Discovery Group of Exploration and Development Companies. To learn more about our exceptional track record,
Lawrence, you mentioned the gold versus the dollar, and there's, as you know, this raging Twitter debate about the future of the dollar, which I think is largely irrelevant, and I don't think anybody can really predict it. But it's still somewhat interesting to sit on the sidelines and watch the heated rhetoric going back and forth, name calling and the like. But there's lots of currencies out there. Do you think the dollar status as the global reserve currency will give it some insulation and make it,
well, it certainly
survive versus the others, or will it put a target on its back?
Well, that's a great question, and I followed all this, and I come down on Luke's side, who I consider to be a friend, and I think I think Brent is smart, and I like him a lot, and and certainly in the shorter term, Brent and Rao have been, right about, the dollar being the cleanest dirty shirt, and there being a bid for dollars because there's dollar denominated debt, which is a short, and everybody therefore needs the dollar. But having said all of that, I'm with you. It's really irrelevant. I mean, whether the dollar is better than the euro or the yen or whatever, I mean, they're all fiat paper, and they're all going to be worthless or worth less relatively than something that can't be debased, which is gold. And so, they're all racing to something that's going to be much lower in gold terms than they are today. And I think gold is going to take its rightful place as the de facto world reserve currency, even though it's not today. The dollar is considered to be the world reserve currency. I think we're entering a period of chaos where the kind of what's the world reserve currency is going to be up for debate. In some ways, fine art and real estate and other tangibles will be kind of a reserve currency because it can't be printed to excess. So as I watch everybody, I often say on Twitter, why are we talking about this? I mean, why are we, milkshake, dollar strong, dollar weak? It doesn't matter. I mean, to me, the cross that matters is the dollar gold cross. I mean, what's the price? If the price of gold is going up, all I know is the dollar compared to gold as a reserve currency, the dollar's losing.
Yeah, I think it's largely a case of your mentality. What we're talking about is long-term macro trends that protect everything you've built to this day to some extent, gold and silver bullion is protection, and also to leverage those moves for long-term capital gains where shorter term traders. And
that's right. That's exactly right. I'm not a trader. I'm an equity investor with a long-term time horizon. I'm looking to compound, and save and preserve purchasing power and compound it. So, and
we're doing this at a time that's a crucial turning point in the markets. I have these discussions with some people, Peter Schiff foremost among them, who think this next cycle is the big one, and this is going to destroy the financial system, or at least a dollar-based financial system. But who knows? I thought that was going to happen the last time. We couldn't do it
too. Yeah, what the last time taught me is it's very, very impossible to know. What you want to try and do is, generally speaking, be on the right side of things, and I think we are. They could do a Roosevelt and restructure. I mean, honestly, I think it'd be an intelligent thing to do if they did a reset, where they said, we're gonna go five old dollars for one new dollar, and the new dollar is backed by gold. I think that's better than letting the whole thing come down in a collapse. Who knows? China could decide they're going to take the yuan and back it with gold. Russia could decide to back the ruble with gold. Russia is actually the best at a macroeconomic level. Russia is the best positioned country in the world. I mean, they have a very low debt burden. They have a lot of natural resources and all the oil that they have, oil, gas, and coal that they have. And, they don't run big budget deficits, and they don't have enormous, social welfare programs that are unfunded. So, sounder currencies are going to emerge. I mean, another competing candidate is Bitcoin. Obviously, very early days. A lot of people think it's risky. There certainly are some risks. But, I also on Twitter, I see the Bitcoin people and the gold people going at each other. And I'm kind of like, guys, stop it. Same team, right? I mean, any currency that's sound, that has a limit on its issuance, is, in my view, a candidate for a replacement for what we've got right now, which is badly broken currencies that are being debased at an enormous rate, just enormous. So, and to me, it's really the trouble of our age. I mean, I see the country tearing itself apart over a lot of things that, obviously some of which have some importance, but, we should be, they should be, they should be looting the Federal Reserve, not all the stuff they're looting. I mean, if you want to know what's caused a lot of pain and anguish and wealth inequality and social discord in this country, start with the fact that the money hasn't been sound, and that since 1971, the average wage earner has been severely disadvantaged compared to the financier, who's been able to borrow and play games and make money as a result of their financial wizardry, while the wage earner just keeps earning the same amount, and which ultimately becomes less on a relative basis. I mean, this all goes to the Cantillon effect, where the people who get the money first have a huge advantage. So it's kind of tragic.
Lawrence, one of the strange aspects of us discussing the problems of money printing or expansionary monetary policy is that within the academic community, there's a strong sense that actually the Federal Reserve should be much more activist, should actually be going further and pushing even negative rates. How do you respond to these supposed gurus of the profession?
I can't wait until these people are just disgraced and written about in the history books as the John Law-like characters that they are. I mean, it's beyond the pale that, Ben Bernanke was supposedly a scholar of the Great Depression and never considered the Austrian theory of why it occurred, which is the Federal Reserve was created in 1913, and allowed a credit bubble to form in 1929. The Federal Reserve has, 20,000 employees with an average salary of $200,000 a year. I mean, that's a crime. All these people, they're so wrong, and they are so misguided with respect to their understanding of, the effects of fiat money versus sound money. Keynesianism is a crime. Keynes, apart from the fact that he was a pedophile, he was also, a guy who said something which was truly evil, which is in the long run, we're all dead, therefore implying that our behavior today did not matter. And there just couldn't be anything more evil than that thought pattern in my mind. Everyone's behavior matters, at least in the belief structure that I hold. And, to me, it's actually, this is why I know gold people are painted as being strange or inappropriate. But to me, it's actually a moral issue. The Bible had it, right? Honest weights and measures, right? And, the minute you take away honest weights and measures and start gaming around with the value of the money, you open yourself up to all kinds of mischief. And I think that it's very, very bad that we do not have absolute standards as regards our monetary system.
You bring up something, that line of thought brings up something I really had never considered before. We know, and it's been proven and said throughout history, that price inflation is a way to line the rich man's pockets. He can avoid it. He can take advantage of it.
Right.
Where it really, the real victims are the lower economic classes who can't get away from it. They have to pay those prices every day, and it's really a tax on them. And it seems like the last cycle, that inflation was financial asset inflation, and it almost seems like that was a devious way of going about it. Okay, we can't hit the price inflation. Let's just do financial assets and enrich ourselves this way. And whether by intention or not, they've kind of avoided that public opprobrium for engendering price inflation, and they've basically gotten away with it.
Yeah, that's exactly right. It's sad that our country, so much of our country, is ill-educated about these monetary issues, and the Fed's a big part of it. The Fed actually spends enormous sums of money, endowing seats and paying for papers written by academic economists. I went to a very good university. I studied economics there. I can assure you there were no Austrian economic books or studies talked about. It was straight Keynesianism. And the reason is, if you're in the economic world, economic community, you get an economics PhD, if you're an Austrian, you're ostracized, literally. You can't survive in that world because, they are all statists, and they all believe that the state is all powerful and important. And therefore, they've created an economic model and system that defends and promotes the state as the arbiter of, economic rules and laws. And so they think they should be sitting there setting the price of money. The notion that, a bunch of guys on the Federal Reserve Board, and I went to school with one of them, Rob Kaplan at HBS. The notion that these guys can sit there and set interest rates and do it correctly. This is like the Politburo saying they can set the price of wheat. It's absurd. It's patently absurd. And yet nobody questions it. This emperor is completely naked. And it's only guys like Schiff and Brian and myself and Egon and, Alistair and, a handful of others. I mean, many others that are, Chris Martinson, et cetera, that are all on Twitter and, screaming it from the top of our lungs and saying, look, we can see what's coming. And, those of us who are looking to save money, I'm 63, I'm looking to save money, retire, protect my family, et cetera. You absolutely positively have to be in something that they can't print. And, because this is not going to end well. We can see where it's going.
Yeah, there's actually a wonderful piece of research from Econ Journal Watch about the way the Federal Reserve has polluted or contaminated the economics profession because so many people are employed by that system or have their research funded by it.
Absolutely.
Now, we are coming up against the end of our time, but you mentioned you've got a second quarter report coming out in the next few days, and how can people subscribe to that?
Yeah,
get a copy of that.
Right. So I'm going to make everybody do a little bit of work. In the past, I was on Max Kaiser's podcast, and I suggested that if people sent me an email, I would send them my report. Well, I got over 2,000 requests, and that took me a lot of time, and I don't have a secretary. So you're not going to be able to get my report unless you get on Twitter. But I tell you what, you're going to enjoy being on Twitter anyway. So if you go on Twitter and you follow me, Lawrence Lepard, you're going to see, I'll post it this morning, you're going to see a link that automatically signs you up to my email. And I'm not going to junk spam you. You can quit at any time. It's a MailChimp link. And when I finish my quarterly report, which will be in the next day or two, I will send it out to you as if you've subscribed to that link. So it's just Circle A, my name, Lawrence Lepard, it's like leopard without the O, Lepard. And I will put this link up there. Just go self-subscribe, and when the report gets written, you will get a copy of it. And in fact, for those who've written to me and asked for the report and I have not sent it, I apologize. I'm backlogged. I've got so many emails. It's kind of, as this area has gotten really hot, and I've gotten a lot busier. But that'll automatically do it. You'll get the report if you subscribe to the list.
Okay, we really have to wrap it up there. People go to goldnewsletter.com/podcast for all the links, including to Lawrence's Twitter. Otherwise, Lawrence, mate, we ran through the time. I look forward to having you on in future. Thank you.
Ryan, really nice to talk to you, and thank you very much for having me on your show. I really appreciate it.
Yeah, Lawrence, great to meet you virtually at least. It's been a great avid follower of your work on Twitter, and
likewise.
Good to talk to another gold bug.
Yeah, you and your father have done great things down there in New Orleans. I'm hoping when COVID's gone, I'm coming to your show.
Yeah, well, we might try and get you on this year. It's going virtual, so we'll hope.
That'll be fun. Okay, great.
Make
sure you send me links. If nothing that's virtual, I definitely want to get on and watch it. Okay.
Gotcha. We will do so.
Thanks, guys. Take care.
Thank you.
Bye-bye.